This is a constant theme that gets thrown around profusely, that a mortgage crisis of the type that happened in the US and that was one of the triggers of the financial crisis cannot happen in Canada or in Australia or in the UK or in other markets that have had a huge housing bubble, that this type of mortgage crisis simply cannot happen in these countries even during a big housing bust where home prices plunge as they did in the US, because the mortgage laws in those countries don't allow homeowners to just walk away from the mortgage debt as US homeowners can. And this theme is wrong. The simple fact is this: when a housing downturn gets big enough and prices fall far enough, and in much of the country, there will be a mortgage crisis, and it will hit banks, shadow banks, and mortgage insurers, no matter what the mortgage laws are. That's what the US mortgage crisis and the Spanish mortgage crisis have demonstrated in ample and brutal detail. Yet many industry organs and media outlets in Canada, Australia, the UK, and other places with housing bubbles that are now deflating are trying to hide behind a false understanding of mortgage laws in the US and what happened during the mortgage crisis. What happened in the US cannot happen here, they say, to soothe the jittery nerves. So I'm going to unsoothe those jittery nerves. Ladies and gentlemen, I'm Wolf Richter of WOLFSTREET.com, and you're listening to the Wolf Street Report. It's Sunday, March 12th, 2019. Home prices have started to decline in some of the formerly hottest housing markets, including in Sydney and Melbourne, in Australia, in Vancouver, Canada, in London, and some other places. And these declines are starting to mirror the early phases of the U.S. housing bust. During the U.S. mortgage crisis, there was a phenomenon called jingle mail, when homeowners and small-scale investors who were unable or unwilling to make mortgage payments on their properties that had lost a large amount of value essentially abandoned the place, figuratively mailing the keys to the bank and saying that this is your problem now. This became a problem only after home prices dropped substantially below the amount people owed on their mortgages, which made it impossible for them to sell the home and pay off the mortgage. So they shook off an underwater mortgage, meaning that they sloughed off to the bank a house that had more debts on it than the house was worth. This phenomenon took various forms, such as homeowners who stopped making mortgage payments but continued to live in the home, sometimes for years, because the foreclosure process was hopelessly bogged down. This process was worsened by an unemployment crisis when millions of people lost their jobs and simply couldn't make the mortgage payments. Mortgages are never a problem in a rising housing market. Default rates are minuscule because when push comes to shove, it's easy to sell a home and pay off the mortgage. And during these times, lenders hide behind these minuscule default rates and issue riskier and riskier mortgages. But these default rates are only minuscule because home prices are rising, and borrowers who cannot afford the payments for whatever reason can sell the home and for more money than they owe and pay off the mortgage and avoid default. So no problem. But when home prices drop sharply after years of loosey-goosey mortgage lending and low down payments, there is suddenly no equity cushion for people who bought in recent years or who did cash-out refis in recent years, and defaults begin to soar and become a problem that very predictably came out of nowhere. Over the years, the theory spread that the U.S. mortgage crisis happened because people could legally just walk away from their mortgages and their homes because banks could not pursue homeowners beyond foreclosing on the collateral. So jingle mail was the universal way out for underwater homeowners, the theory goes. But because Canada, Australia, and other countries have unforgiving mortgage laws, homeowners cannot and will not walk away from the mortgages once prices drop, and they will make the payments, and banks will be just fine. But here is where this assumption is wrong. In the US, each state has its own mortgage laws. There are only 12 states where jingle mail is possible. In the other 38 states and in Washington, D.C., the mortgage laws mirror those unforgiving mortgage laws in Canada and Australia. This includes Florida, the epicenter of the mortgage crisis. In terms of residential purchase mortgages, not counting refinance mortgages, the U.S. states fall into two categories: states that have recourse mortgages and states that have non-recourse mortgages. A recourse mortgage allows the lender to foreclose on the home, so the collateral, and sell it, and then pursue the homeowner in court for the difference between the proceeds from the sale of the home and the outstanding mortgage amount, plus interest, fees, etc. If the bank wins in court, it will get a deficiency judgment. Armed with this deficiency judgment, a bank can then go after the former homeowner's assets, garnish wages, and hound the homeowner in other ways until the homeowner pays off the deficiency, settles with the bank, or seeks protection in bankruptcy court. And this is where the chase ends. A non-recourse mortgage limits the bank's recovery to the collateral. So the bank forecloses on the house and sells it. But no matter how large the deficiency, the bank has to swallow the loss and move on. And the homeowner or the ex-homeowner has gotten rid of a big debt along with the underwater home. But there are only 12 states in the U.S. that have non-recourse mortgages. These are the only states where homeowners can walk away from a residential purchase mortgage without fears of being hounded by the lender. And these states are Alaska, Arizona, California, Iowa, Minnesota, Montana, North Carolina, North Dakota, Oregon, Washington, Wisconsin, and Nevada. But Nevada became a non-recourse state after the mortgage crisis, when folks there decided that homeowners needed a little more protection. During the mortgage crisis, Nevada's mortgages were mostly recourse, and yet the state too was an epicenter in the mortgage crisis. The other 38 states and Washington, D.C. have recourse mortgages. In these 38 states, lenders are allowed to seek a deficiency judgment on residential purchase mortgages for the difference between what the property sold for and the outstanding mortgage debt, fees, etc. These 38 states and D.C. have mortgage laws that more or less mirror the mortgage laws in other countries. Of the big four states, California, New York, Texas, and Florida, only California has non-recourse purchase mortgages. New York, Texas, and Florida have recourse mortgages. There are numerous other differences between how states handle mortgage defaults. Florida has a homestead exemption, for example, that complicates matters for banks. Also, the property, especially an investment property, may be held by a dedicated LLC with no other assets, which limits recovery efforts by the bank. State laws vary as to how much recourse they allow lenders and on what types of mortgages. So I'm just summarizing here to cover a broad theme, and I'm not giving free legal advice. For legal advice, you have to pay a lawyer. But here's the thing. The mortgage crisis in the U.S. was just as harsh and brutal in the 38 recourse states, including Florida, as it was in non-recourse states. Mortgage laws and the right to hound defaulted homeowners for their last dime did little to nothing to slow down the housing crisis or the mortgage crisis and the damage to the lenders and mortgage insurers. In Canada, mortgages are full recourse except in two provinces that have non-recourse mortgages but with big limitations, Alberta and Saskatchewan. In Australia, the full recourse mortgage is standard as it is in many other countries. In 2008, Spain had some of the most draconian mortgage laws on earth, and yet it had one of the worst housing busts on earth and a terrible mortgage crisis that took down the banking system and required a full-blown banking bailout by special European transnational entities. Under Spain's draconian mortgage laws, banks would evict the homeowners and saddle those evicted homeowners with debts for life that continue to grow with fees and sky-high default interest rates. These people could not ever shed this debt. This draconian law was designed to protect the banks by being a brutal deterrent to potential mortgage defaulters. But this is precisely what it failed to do. It was brutal, all right, but it failed to protect the banks. Clauses in this mortgage law have since been ruled abusive by the European Court of Justice, and Spain has since changed the law. But the simple fact is this: you cannot squeeze blood out of a turnip. When home prices decline sharply, no law can protect the banks from the losses because defaulted ex-homeowners simply cannot pay money they don't have. So Canada and Australia and other markets with majestic housing bubbles that are now deflating all faced the same scenario that the U.S. faced. When home prices drop sharply, a fairly large number of homeowners, especially those who bought in recent years, will abandon their mortgages because they're unable or unwilling to make payments on an underwater mortgage or a money-losing investment property. This becomes a huge issue during a recession when homeowners suddenly lose their jobs. If there are just a few cases, the banks do what they can to get deficiency judgments. They may not make much hay, but they will try. They do that in the US and they do it everywhere. They're set up to do this, and they have a system in place to hound a few defaulting homeowners here and there. But even then, as in the US, people can seek protection from creditors by filing for personal bankruptcy. By this time, there is usually nothing left for the bank to recover. For banks and mortgage insurers, these are costly processes with minimal or no payoff at the end. So they may choose to sell the defaulted mortgage for cents on the dollar to get the problem off their books and let someone else go after the homeowners. And this system works. Anytime a bank lends money, there are some risks involved and some losses, but banks and mortgage insurers and investors get paid to take those risks. Part of the interest they collect compensates them for taking this risk. But under a tsunami of mortgage defaults, as was the case in the US, lenders and mortgage insurers and the legal system are totally overwhelmed. The whole system bogs down. Lenders and courts don't have enough staff to even deal with it. The system is designed for the typical low default rates and not for a flood of defaults. And so banks are even less likely to pursue defaulted homeowners for deficiency judgments. In a crisis like this, some lenders are already in trouble. Some of them are on the verge of collapse, and others have already collapsed. The last thing they can do is hire thousands of lawyers and credit specialists to deal with a tsunami of defaults. This is a typical case where a system is overwhelmed and fails to function as intended. There are parts that go haywire. There are parts that lock up. There is chaos and lenders lose track, or they choose to outwait the crisis and sort through things one by one, even years after the fact. In the US, government-sponsored entities that guaranteed mortgages or insured them or bought mortgages and converted them into mortgage-backed securities ended up with many of the defaulted mortgages, and they have trouble hounding a large number of defaulted homeowners because these homeowners are voters, and there is a public uproar about the government pursuing defaulted homeowners. So, as the U.S. mortgage crisis has shown, and as the Spanish mortgage crisis has shown, even draconian mortgage laws cannot prevent a mortgage crisis when home prices fall far enough across the country and a large number of homeowners get in trouble at the same time. In a broad and steep housing bust, the mortgage laws on the books, no matter how draconian, will not and cannot prevent a mortgage crisis and will not and cannot protect the banks. Ladies and gentlemen, I'm Wolf Richter of WOLFSTREET.com. Thank you for listening to the Wolf Street Report.